In 1902, archaeologists excavating ancient Nippur in what is now Iraq uncovered thousands of clay tablets. Among them, detailed records of loans from 2400 BC, amounts borrowed, interest rates, repayment schedules, collateral pledged. The tablets documented farmers borrowing seed grain before planting, merchants financing trade expeditions, and temples extending credit to communities. 4,000 years ago, debt already functioned as it does today, enabling activity beyond immediate resources while creating obligations that stretched into the future. The specifics changed. Clay tablets became paper ledgers, then digital entries. Barley loans became mortgage-backed securities. Temple priests became central bankers. But the underlying pattern remained remarkably consistent. Borrow to enable growth, manage the resulting obligations, periodically face strain when growth disappoints, adjust and begin again. The common assumption treats different debt forms, sovereign bonds, commercial loans, consumer credit, as separate phenomena shaped by their specific contexts. The historical reality reveals something more nuanced. Recurring patterns link these seemingly diverse forms. The instruments evolve, but the dynamics show remarkable persistence. The question becomes, what enduring patterns does debt exhibit across radically different eras, and what do those patterns reveal about human economic behavior? To understand debt's enduring patterns requires recognizing that borrowing has never been peripheral to economic life, but central to how societies function and grow. Ancient economies operated with debt as foundational infrastructure. In Mesopotamia, the earliest written records, predating literature or law codes, document loans. This wasn't accidental. Writing emerged partly to track obligations across time. The temple and palace systems that organized these early states depended on credit to smooth seasonal agricultural cycles, finance long-distance trade, and maintain administrative functions between harvests and tribute collections. The attitude toward debt was pragmatic. It was neither celebrated nor condemned wholesale, but understood as a tool that enabled activities otherwise impossible. A farmer with only his current grain stock couldn't plant a full field, but with a loan of seed grain, he could expand cultivation. A merchant with only his immediate capital couldn't fund a caravan to distant markets, but with credit, he could participate in profitable trade. The debt made future-oriented activity possible. This pattern persisted across subsequent civilizations. Medieval European commerce depended on bills of exchange and merchant credit networks. Renaissance city-states funded development and warfare through sophisticated borrowing arrangements. The key innovation in each era wasn't eliminating debt, but finding institutional forms that made it more reliable and expansive. By the industrial era, borrowing had become explicitly associated with progress. Canals, railways, factories, the infrastructure of industrial transformation, required capital beyond what any individual or company possessed through savings alone. Joint stock companies, corporate bonds, and banking systems evolved to channel borrowed funds into these enterprises. The worldview supporting this expansion rested on belief in future growth. If economies would be larger tomorrow than today, borrowing from that future prosperity made sense. The debt would be repaid from increased production, expanded trade, or new wealth creation. The logic seemed sound. Leverage present resources through borrowing, invest in productive capacity, repay from enlarged future output. Systems felt stable because for extended periods, this dynamic worked. Economic historians document long stretches, decades sometimes, where growth did exceed debt accumulation, where investments paid off, where obligations were manageable. These successful periods reinforced confidence that the pattern could continue indefinitely. But stability was never permanent. Eventually, growth disappointed, wars disrupted trade, investments underperformed, harvests failed, political upheavals changed conditions. When growth faltered while obligations remained, strain appeared, defaults occurred, restructuring became necessary, credit contracted. These adjustments weren't catastrophic endings, but rather phases within a longer cycle. After contraction came gradual recovery, renewed confidence, and eventual expansion into another cycle of borrowing-driven growth. The pattern repeated across contexts, suggesting it reflected something fundamental about how debt interacts with human economic behavior and systemic dynamics. The history of debt across eras unfolds through recurring waves of expansion and adjustment, each distinct in detail but recognizable in structure. Ancient debt cycles. Mesopotamian records document multiple debt crises over 2 millennia. During prosperous periods, lending expanded. Farmers borrowed heavily. Merchants leveraged extensively. Then disruption would occur. Drought, war, political instability, and repayment became impossible for significant portions of the population. The systematic response was debt forgiveness proclamations by rulers. These weren't acts of charity but administrative necessity. When too many people fell into debt bondage, agricultural production collapsed and social stability fractured. Periodic clean slates, canceling debts and returning land reset the system, allowing expansion to resume. This pattern appeared across ancient Near Eastern civilizations. It wasn't unique to poor governance or primitive understanding. It emerged from the structural dynamic. Debt accumulated during good times, became unsustainable during bad times, required adjustment for the system to continue functioning. Medieval sovereign debt. European medieval and Renaissance states developed more sophisticated borrowing mechanisms but encountered similar patterns. Italian city-states, Venice, Genoa, Florence, borrowed extensively to finance wars and commercial expansion. For periods, the system functioned well. Trade generated revenues that serviced debt. Confidence remained high. Then periodic crises erupted. Wars became more expensive than anticipated. Trade routes disrupted. Expected revenues disappointed. Defaults or forced restructurings followed. Creditors lost capital. Credit contracted. Eventually, conditions stabilized and the cycle resumed. The pattern was particularly visible in Spanish imperial finance. Spain borrowed massively from German and Italian bankers, backed by New World silver flows. For decades, the arrangement functioned despite high interest rates. Then Philip II declared payment suspensions in 1557, 1575, and 1596. Each was presented as temporary adjustment, and each was eventually resolved through restructuring that allowed resumed borrowing. The repetition reveals the pattern's persistence. Neither borrowers nor lenders fully internalized lessons from previous cycles. Optimism during prosperous periods encouraged expansion that later proved excessive. Memory of crises faded as new participants entered markets. The cycle renewed. Industrial-era infrastructure debt. The 19th century saw debt expansion on unprecedented scales to finance industrial infrastructure. Railways particularly exemplified the pattern. Britain, the United States, and other industrializing nations borrowed enormous sums to build rail networks. Initially, optimism was justified. Early railways generated substantial returns. This success encouraged more borrowing for additional lines. Competition intensified. Lines were built into areas with insufficient traffic to justify costs. Speculation drove valuations beyond realistic earnings potential. The result was periodic railway crises, sharp downturns where many companies failed, bondholders lost capital, and credit contracted. The 1840s British railway mania ended in bust. American railway expansion generated periodic crises in the 1870s and 1890s. Each episode followed the familiar pattern: optimistic expansion, overextension, disappointment, adjustment. Yet the long-term effect was transformative infrastructure development. The debt financed real productive capacity even when individual ventures failed. The pattern involved waste and pain, but it also channeled resources toward large-scale projects that wouldn't have been built through pay-as-you-go financing alone. Sovereign debt in developing economies. Latin American nations in the 19th and 20th centuries experienced repeated debt cycles. After independence, they borrowed in European capital markets to fund development. Initial loans were absorbed, sometimes productively. This encouraged more lending. Optimism grew about development potential. Then commodity price declines, political instability, or external shocks made obligations unsustainable. Defaults followed. Bondholders formed committees to negotiate. Settlements eventually occurred, typically involving partial repayment and extended terms. Years later, with memories faded and new investment opportunities apparent, lending resumed. The pattern repeated with remarkable consistency. 1820s boom and 1830s bust, 1870s expansion and 1880s crisis, 1920s lending and 1930s defaults, 1970s lending and 1980s debt crisis. Each generation of lenders and borrowers entered believing they had learned from previous mistakes, yet the cycle repeated. Unintended consequence, periodic strain and adjustment. The human decisions driving these patterns were individually rational. Borrowers saw opportunities that required capital beyond their immediate resources. lenders saw returns exceeding alternative investments. During stable periods, both assessments proved correct often enough to reinforce the behavior. The unintended consequence was systemic instability. Individual rational decisions aggregated into collective overextension. When conditions shifted, and conditions always eventually shifted, the accumulated debt became a burden rather than a catalyst. The adjustments that followed were painful but served a function. Defaults and restructurings reduced obligations to manageable levels. Credit contraction forced focus on sustainable activities. The system reset, allowing eventual recovery and renewed growth. This wasn't a failure of the debt mechanism, but rather its operational pattern. Debt enabled activity beyond immediate resources, which drove growth, but it also created vulnerability to disappointment. When growth disappointed, adjustment occurred. The pattern's persistence suggests it reflects fundamental aspects of how debt interacts with human judgment about uncertain futures and systemic dynamics of growth cycles. Innovations in response. Each era developed innovations attempting to manage the pattern more smoothly. Bankruptcy laws formalized default procedures. Central banks emerged partly to provide liquidity during crises. International institutions like the IMF were created to coordinate sovereign debt restructuring. Financial instruments became more sophisticated in allocating risk. These innovations mattered. They affected how severe crises became and how quickly recovery occurred. But they didn't eliminate the underlying pattern. Optimism during good times still encouraged overextension. Shocks still occurred. Adjustments still proved necessary. The innovations modified the pattern's expression without fundamentally altering its presence. Across these varied historical episodes, certain patterns recur that illuminate consistent aspects of how debt functions in human economies. Growth through leverage. The first pattern is debt's role in enabling growth beyond what would occur through savings alone. This appears consistently across eras. Agricultural expansion in Mesopotamia, commercial networks in medieval Europe, industrial infrastructure in the 19th century, modern economic development, all were accelerated through borrowing. The mechanism is straightforward. Debt allows present use of future resources. If those resources are invested productively, they generate returns that exceed borrowing costs. This multiplier effect, using leverage to amplify growth, appears repeatedly throughout history. The pattern illustrates both opportunity and risk. When investments perform as expected, debt accelerates beneficial outcomes. When they disappoint, debt amplifies problems. The same mechanism that enables growth during expansion creates vulnerability during contraction. Optimism during stability. A second pattern involves the reliable emergence of optimism during extended stable periods. When economies grow consistently, when recent memory holds no major crises, both borrowers and lenders become more confident. Projections assume current conditions will persist or improve. Caution erodes. This isn't irrationality, but rather normal human response to experienced conditions. During genuinely stable periods, optimistic projections often prove accurate. The cognitive error lies in assuming stability will continue indefinitely. Yet this error is difficult to avoid because the future remains genuinely uncertain. No one knows when conditions will shift. The pattern helps explain why debt cycles repeat despite accumulated historical experience. Each generation experiences its own stable period and forms optimism based on that experience. Abstract knowledge of previous cycles doesn't override lived experience of current stability. Cyclical adjustment. A third pattern is the cyclical nature of debt expansion and contraction. Periods of aggressive borrowing are followed by crises and retrenchment, which eventually give way to renewed expansion. The cycles vary in length and severity, but the basic pattern recurs. This cyclicality suggests debt dynamics aren't linear. They don't simply expand or contract consistently. Instead, they oscillate between phases. Expansion generates conditions that eventually necessitate contraction. Contraction creates conditions that enable renewed expansion. The pattern implies that attempts to eliminate crises entirely may be misguided. The crises serve a function within the larger cycle. They force adjustment of obligations to sustainable levels and redirect resources toward more viable uses. Preventing all crises might preserve vulnerabilities that become more severe when finally expressed. Institutional evolution. A fourth pattern involves institutional adaptation in response to debt crises. Each major episode prompts reforms intended to prevent recurrence. New regulations, different organizational structures, additional oversight mechanisms. These innovations accumulate over time, making financial systems more complex and, in some dimensions, more resilient. Modern bankruptcy law, central banking, international lending institutions all emerged from previous crises and represent attempts to manage debt dynamics more effectively. Yet institutions don't eliminate the underlying pattern. They modify how it expresses, but don't fundamentally alter the dynamic of optimistic expansion followed by periodic strain. The pattern operates through whatever institutional structure exists, adapting to work within new constraints. Balance between expansion and caution. A fifth pattern relates to the ongoing tension between growth-enabling expansion and stability-preserving caution. Societies and individuals must navigate this balance repeatedly. Too much caution forgoes beneficial opportunities. Too much expansion creates unsustainable fragility. The historical record suggests this balance isn't achieved once, but must be continually renegotiated as conditions change. Each era, each business cycle, each individual financial decision involves reassessing the appropriate point along this spectrum. The enduring patterns of debt reflect this perpetual balancing act and the human tendency to misjudge the appropriate equilibrium during both stable and volatile periods. The patterns visible in historical debt cycles echo in ways that transcend specific eras, suggesting something persistent about the relationship between borrowing, growth, and human judgment. Consumer credit in modern economies shows structural similarities to ancient agricultural loans. Both enable consumption or investment beyond immediate resources. Both create obligations that stretch across time. Both function well when incomes rise as expected and create strain when they don't. The centuries separating them and the institutional differences between them don't obscure the common pattern. Corporate debt in various industrial periods reflects similar dynamics. Railroad companies in the 1800s, utilities in the early 1900s, technology firms in recent decades, all borrowed to fund expansion, experienced periods where optimism justified high leverage, and periodically faced strain when growth disappointed. The specific technologies and regulatory environments differed dramatically, but the pattern of leveraged expansion and periodic adjustment remained recognizable. International lending shows the pattern across different borrower categories. Medieval city-states, 19th century developing nations, and modern sovereigns all borrowed to fund development and all experienced cycles of confident lending, followed by crisis and restructuring. The institutions intermediating these flows evolved significantly, but the underlying cycle persisted. The echoes appear even in debt forms that seem distinctly modern. Securitization, pooling loans and selling claims on the pool, has ancient precedents in how medieval merchants shared risks across ventures. Leveraged buyouts echo patterns of control acquisition through borrowed funds visible in earlier eras. The specific mechanisms are new, but they operate according to dynamics with long historical precedent. This isn't a claim that nothing changes. Financial systems are dramatically more complex, interconnected, and large-scale than ancient equivalents. Institutions have evolved substantially. Understanding has deepened. Yet beneath this evolution, patterns persist in how debt expansion and contraction unfold, how optimism and caution cycle, how leverage amplifies both growth and vulnerability. The observation suggests these patterns reflect fundamental aspects of human behavior and economic dynamics rather than failures of specific institutions or knowledge gaps. They emerge from how humans think about time and uncertainty, how growth and leverage interact, and how individual rationality can produce collective outcomes that weren't intended or desired by any participant. 6 quiet closing insight, approximately 200 words. The question posed at the beginning, what enduring patterns does debt exhibit across radically different eras, has an answer visible across 4 millennia of economic history. Debt appears consistently as a mechanism that enables activity beyond immediate resources, accelerating growth during expansion and creating vulnerability during contraction. It cycles between periods of optimistic expansion and periodic adjustment. It prompts institutional innovation while operating through whatever institutional structures exist. It requires continual balancing between opportunity and risk. These patterns persist not because societies fail to learn or improve, but because they reflect fundamental dynamics of how borrowing interacts with human judgment about uncertain futures and systemic properties of economic growth cycles. The innovations of each era modify how these patterns express without eliminating their underlying presence. Understanding this provides perspective on debt's role in history, neither purely beneficial enabler of progress nor merely destructive creator of crises, but rather a persistent tool whose effects depend on how it's deployed within specific contexts, always accompanied by distinctive risks that periodically materialize. Debt endures as a quiet companion to progress, enabling advances that wouldn't occur through savings alone, while periodically requiring adjustments when optimism exceeds reality, and consistently revealing patterns that transcend the enormous differences between clay tablets and digital ledgers. The patterns reward observation without prescription, illuminating what has been without dictating what should be.